Here's a quick tip about how to manage your cash flow, especially when you've got clients that take a long time to pay. There's probably 2 or 3 ways of bridging that gap between the time you send an invoice out and the time you get the cash in the door. First one, just use your own cash flow. Maybe you've need sufficient equity in your business to pay your invoices and pay your bills and pay your salary and wages from the time that send out your invoice to the time you get the cash in the door. That's an expensive way. Option 2, you can use credit cards or other terms of short-term financing. While these are expensive, they can help bridge that gap. So a third way of financing is invoice factoring. So what is invoice factoring? Okay, well, imagine this example. You write an invoice today for work for $100,000 and you send that off to your client. Okay, and the client's going to take 3 months to pay. And you know they're going to take 3 months to pay because that's just the nature of the industry or the sort of. But $100,000, let's say that's a chunky piece of cash flow for you. How are you going to manage over the next few months with that cash coming in the door? Well, invoice factoring can be something to think about. Right? So how does this work? Well, you take your invoice for $100,000 and you give it to a factoring company. Banks do some of this stuff. Non-bank lenders do it as well. And in fact, if you look inside tools like Xero and QuickBooks, there are sometimes links to press that will actually automatically do this for you. Okay, not an endorsement, but I'm just saying they will. They're trying to make it easy. Because what happens is you give across your invoice today, and that might give you $70,000 in cash. Great, you got your cash up front, but only 70 of it, not the full 100. And so what happens is in 3 months' time, when the client finally pays, they don't pay you, they pay the factoring company, they give them the 100, and they might turn around and they might give you the remaining 10 at that point in time. So they've kept 20 and you get 80. Now, that's quite an expensive bit of cash taken out. But at the end of the day, if you need the cash up front, and you need the cash quickly, it could actually be a pretty efficient tool to use in managing the cash flow of your business. And there are certain businesses out there and certain industries out there that just do this month in, month out. They continually factor the invoices every single month. And so something to think about.